Okay, it's that time again. Hopefully things will go better this week than last week. And again, I apologize for the technical difficulties that we had last week. I've gotten a new router and rebooted everything just before we started. So hopefully we don't have any issues today. All right, so obviously the big news last week was the EPA finally released biofuel mandates for 2020, 21, and 2022. The mandates came in pretty much as expected. That said, they did provide some certainty for the market finally, and the EPA did cut 2020 and 21 mandates. Whether they can actually do that or not, I think still remains to be seen, and probably will end up in the courts like most EPA decisions do. One of there were two interesting things probably beyond the level of the mandates. The first is that the EPA decided to deny all small refinery exemption applications for 2019 and 2020. So we took those out of our forecast. We had some small refinery exemptions built in, much lower than the level that we had seen over the past several years, but we still had some built in. So we took those out. And then the other thing that was interesting was that they also added a supplemental mandate, 250 million gallons in 2022 and 250 million gallons in 2023. That's to settle a court decision from a previous judgment, I guess, that the EPA made, and adds back 500 million gallons in mandates that were supposed to have occurred in a prior year. There is, I suppose, some potential for a similar kind of outcome for the mandates for 2020 and 2021, because at least it looks to me like the changes that they made probably went beyond what the law says that they can do. Now, that is, I don't know that that's likely or even probable, but it is something that leaves a little bit of uncertainty going forward. Nevertheless, we made some adjustments to our feedstock usage model and our biofuels production model based on the new mandates. And the net result of those was a pretty substantial reduction in our forecast for soybean oil usage in biofuel production. You can see for 21, 22, now we are basically just about a little more than 850 million pounds above where USDA is. And that's a big difference from where we were in the prior week, when we were several billion, at least, pounds above where USDA was. The bulk of that change, the mandates came in about where we expected, a little bit lower than we expected for 2022, but not much, less than 100 million gallons, I think. But the bulk of the cut in our expectations really is, if you look at the mandates and then you look at biodiesel capacity and you look at renewable diesel capacity, or anticipated renewable diesel capacity by the end of 2022, you have a lot more production than you do mandate. And so something there is going to have to give. And the way that we're handling that, at least at this moment, until we start to get into 2022 and get more data on exactly what's happening, is we throttled back our forecast for capacity utilization in renewable diesel production, and we lowered that to about 80%. Now, I'm assuming that any plant that opens up is going to run as close to full capacity as humanly possible. But and especially at these feedstock prices, but there has to be some give. And we also took our forecast for biodiesel production down. There has to be some give someplace. I think ultimately, just like everybody else, that where that comes from is a rationalization of biodiesel capacity. and that you end up with only really large or integrated biodiesel producers sort of surviving the rationalization that's going to come. However, in the interim, I think that it's going to be tough for everybody to produce at full capacity. And so that's the way that we handled it. If we get halfway through the year, and I say halfway because we really don't expect a lot of new renewable diesel capacity to start to come online until the second quarter of 2022. If we get halfway through the year and renewable diesel production is running well above where we expect it to, based on our assumption of when plants are going to come online, then we probably will raise it back up. But for now, this is kind of the outline of how we're going to try to approach analyzing these markets. The net result of that was that in addition to the cut in non-biofuel use, you also then had room, one, to drop our forecast for soybean oil imports back to what we think of as sort of a normal level, 350 million pounds a year. But you also had room to increase non-biofuel use back to what we consider normal, which is about 14 billion pounds or a little bit more than 14 billion pounds a year. That has a lot of implications for not only soybean oil, but also for the rest of the feedstocks. And so because of that, there's not as much pressure on canola oil to meet the non-biofuel demand that couldn't be met because of higher feedstock demand for soybean oil, and that translates all the way down the feedstock line. So it's similar in fats and greases. And generally, what happened in the fats and greases balance sheets is we raised our forecast for consumption of fats and greases and lowered our non-biofuel usage for fats and greases, although in some cases we also raised our non-biofuel usage for fats and greases because the cut in biodiesel gave us a lot more supply in those areas, just like it does with soybean oil. What does that mean for price? So if you assume that integrated biodiesel producers are profitable around 55, 56 cents, somewhere in there, and our estimate of profitability for just a biodiesel producer that is shipping into California is profitable at prices that are close to the current level, that means that there's going to be a range in prices that is probably lower than we were expecting before. And as a result, we cut our forecast for soybean oil futures prices by 5 cents a pound out forever, basically. Again, if production comes in above where we're expecting, we'll obviously revisit that. But to me, it looks like you probably have a range for the futures market between 49 cents and if you consider the upper end, sort of 77, 78 cents for RBD and a spread to futures from RBD of 17 or 18 cents, that gets you to 60 cents on the upside. Obviously, right now, the futures market is going through a pretty substantial liquidation of the speculative position that had been built up in anticipation of all of the renewable diesel capacity that's coming online. Like all either buildup or liquidation of speculative positions, that probably will take prices outside of sort of the fundamentally justifiable range. So even though we're down another penny and a quarter today, it wouldn't surprise me to see prices drop below the 50-cent level and maybe down to 48, 47 cents. But the big question right now has sort of shifted from, how do we meet this non-biofuel demand to what happens when prices drop down to 50 cents or drop down below 40 cents? below 40 cents, most biodiesel producers should be profitable. And obviously most renewable diesel producers, or all renewable diesel producers, will be profitable. At that point, it becomes really hard to argue that renewable diesel capacity utilization is going to run at 80%, or anybody's capacity utilization is going to run at 80%, or that biodiesel production is going to be down as much as we expect. If I'm a biodiesel producer and I see the writing on the wall, I'm going to try and make as much hay while the sun shines and feedstock prices are low as humanly possible, because I know that effectively my days are numbered. So again, we're kind of in this weird situation where we've cut the demand for feedstocks. That's going to mean lower prices, but lower prices means more demand for feedstocks. And finding a balance between those two is something that, to be really frank, is just going to take a lot of time. I wish that I could kind of wave a magic wand and know exactly how all of that shakes out. But I can't. I'm an analyst, and so by nature, I'm wrong quite a bit. Nevertheless, we do still think that that the trading range for futures is 49 to 60 cents, and then you can create spreads to all of the other feedstocks and all of the different soybean oil standards, RBD and such. I can't think of the proper word for that, to create a similar range for those other commodities. All right, so that's kind of the broad outline of what we did and how we treated the EPA mandates. For canola oil, US canola oil, you have kind of a similar effect where we cut biofuel usage down from about 1 billion pounds to 850 million or so. Again, this reduces the demand for imports, but it also, that's relatively minor, because it also means that non-biofuel demand can continue to be where it was last year, despite the fact that that we've had a drought and both the US and Canadian canola crops are substantially smaller than they have been in recent years. On the US side, or on the price side, we took canola oil prices down, except for the last quarter of the marketing year, which is July, August, September. And we left those prices basically unchanged. We left the price forecast basically unchanged. And that's this big bump here. Because of the drought, we still think that stocks probably are going to get really tight before we harvest the next crop, or as we start to harvest the next crop. And so we still think that there is some upside price risk at the end of the year for canola oil. There will be a lot more vegetable oil available, and so I would say that there's probably some downside risk to this price outlook. And if I was really gonna bet with sort of a gun to my head, I probably would have lowered that price forecast a little bit. But I do think that that there could be some price pressure coming there before we harvest the next crop. And then after we harvest, you can see that we've got prices going back down. In Canada, we got the USDA report last week as well. USDA cut its forecast for production basically in line with what Stats Canada forecast, or maybe still a little bit above where Stats Canada is. And they offset that reduction with the decrease in exports and left their crush number unchanged. So that should leave their crush and canola oil supply unchanged. No, it didn't. They cut their canola oil production by 200,000 tons. They did something similar in their US balance sheet, where they cut US canola oil production as well. That's just an effect of the average yield over the year. And so based on recent yields or early season yields, we had already kind of reduced our forecast for both of those, and reduced our production. They are going in the opposite way from soybean oil yields, which are high and expected to be even, they were high last year and expected to be even a little bit higher this year. All right. I guess I should also note that USDA came out and they made some changes to their balance sheets. They added, again, 200 million pounds to soybean oil production based on that yield change. And then they offset that with an increase in non-biofuel usage of 150 million pounds, and 50 million pounds fell to ending stocks. USDA noted in the WASDE report that they had seen the mandates, incorporated them into their forecasts, and didn't see a need to make a change to their prediction of 11 million pounds of soybean oil. So there, we don't have to wait for a whole another month to figure out what USDA thinks about the mandates. For palm oil, we got the Malaysian Palm Oil Board report last week as well. That came in with stocks that were sort of a little bit above market expectations. You had production fall much more than expected, but in line with what you would typically see during the typical seasonal, the average seasonal decline. So to me, that kind of answers the question of what's the impact of this effort that the government made to work with the plantations and get more foreign workers in to harvest palm. It looks like it's kind of business as usual. And so we changed our monthly forecast for production, but we didn't change the marketing year forecast. We just kind of shifted production around from 1 month to another, so that the month over month changes were more in line with what you would see during the average year. We'll see if that continues to hold. I think there's maybe some chance that as we get out of the seasonal decline and start to ramp up production next spring, production could be a little bit stronger than expected, and maybe we'll end up taking our predictions up for production once we get there. But in the short term, I think 19 million pounds is going to be pretty close. Probably the biggest surprise in the MPOB data was the export data, which came in substantially lower than expected. It still was a little bit less than a 6% increase month over month, but the market had been expecting nearly 12%. We expected almost 11% based on the cargo surveyor data. And that is why you had sort of larger than expected end of month inventories. The export thing is probably where the market's going to turn its focus now. We still are in this spot where the world is kind of short vegetable oil, and so export demand should be pretty good. You've had a significant narrowing of the spread between palm oil and soybean oil, particularly from last summer's highs. So the substitution of palm oil isn't as attractive as it was when there was a 30% gap there. It's back down to the normal kind of range, the long-term average, and we expect it to kind of stay in that area and then maybe creep up a little bit as renewable diesel capacity comes online. So we expect that it could go back out to 10 cents. If it does go back out to 10 cents, then maybe exports for palm oil start to pick up a little bit more than expected. However, there's going to have to be, at some point, there's going to have to be some more demand for palm oil. India and in China both need palm oil, and it's been surprising to me, although I guess it shouldn't be given what's gone on with the pandemic, that demand hasn't been quite as strong as I would have anticipated. As a result, I think, there's probably more risk that market year ending stocks go up, or expectations, at least for market year ending stocks, go up. They have some room to go up before we get to the magic 2 million ton level. But I think that, again, there's probably a little bit more risk to the upside there, both from the fact that production may be higher than expected, and then for whatever reason, exports might not be as strong as expected. If exports are as strong as expected, I think that the downside to the to expectations for inventories are probably relatively limited. And prices are, although they've come down a lot, particularly last week, they still are relatively close to all-time highs. And so we expect palm oil prices to kind of continue to work lower as we move forward. We don't necessarily expect a big drop, although I wouldn't completely rule that out, especially given what soybean oil is doing. But we expect kind of a slow grind lower as the uncertainty about export demand and production probably carries through at least until, again, we get to the end of the typical seasonal decline in output. All right, on to biodiesel. So our chart this week shows our new expectations for yearly domestic renewable diesel and biodiesel production. You can see we expect that that biodiesel production probably drops off a little bit more than it has in recent years, and we expect a big increase in renewable diesel production. What does that mean for gross margins? So the gross margin picture looks a little bit flatter than it has in recent weeks and months, I suppose. But we still, at least through sort of the second half or through the first half of 2022, expect margins to remain under pressure. Now, that's in part because we expect that energy prices are probably going to continue to decline, but in that probably offsets the decrease that we've built into soybean oil prices. On the fats and greases side, we don't necessarily have as large a decline in prices built into our forecast, just because effectively we're still going to be using all of the fats and greases that we can, and obviously the new renewable diesel capacity is going to prefer fats and greases as feedstocks over vegetable oils because of the CI scores, or at least the new renewable diesel capacity that's going to ship into California, which is quite a bit of it. And so because of that, we don't necessarily see as much weakness in the fats and grease prices as we had been, or as we do in soybean oil. That said, fats and grease prices right now are under pretty significant pressure, in part due to some logistical problems that are going on. It's tough to get rail cars, it's tough to get truck drivers, and in part I think that probably positioning plays a little bit into that too, where a lot of people I think probably bought ahead in the fourth quarter, and now there are additional supplies available that people didn't think were going to be available, and so you have these additional supplies along with the logistical issues, and that's kind of compounding the weakness, especially in sort of the spot market, because there's only a finite amount of time that they have to get this stuff off to a customer. Still, we don't expect margins to be really horrible. Again, we expect biodiesel margins probably to remain negative through much of the year after a little pop here in the short term. Part of that is based on our soybean oil price forecast, and again, I didn't change sort of the shape of the forecast, I just kind of shifted it downward. We still expect the increase in renewable diesel capacity to, once those people come in and start buying, to cause upward pressure on prices. But I'll be honest, it wouldn't necessarily surprise me if I probably start to shade the slope of that line down a little bit in the coming weeks and months as we start to get more information about when people are actually going to open, and as we get through sort of this liquidation of the speculative position. For renewable diesel, we expect margins to come under pressure as well. But we expect that the pressure won't be quite as significant as it is in biodiesel. For RINs, our RIN price forecasts. So a kind of steady D4 prices are around this range. One of the things, excuse me, one of the things that the EPA mandate did by canceling out all the small refinery exemptions is that there were several pretty well publicized companies that were carrying some pretty significant RIN deficits from prior years. And so that probably is going to provide some support for RIN prices. Now, that said, a lot of these companies probably will prefer to meet their RIN obligations if they absolutely have to by buying D6 RINs, which are cheaper than D4 RINs. But D6 RIN prices are an input to D4 RIN prices. And so there's some potential for, even if they did all of D6, there's some potential for that support to translate into a little bit of strength in the D4 market. That said, we are expecting D6 RIN prices to move kind of lower through at least the first half of next year, and the spread between D4 and D6 to become as wide as it's been in a little while. Let's see if I take this out, you can see we're expecting it to be about as wide as it was back here in 2017, and certainly wider than we saw through 2018 and 2019. Without the concern of the ethanol blend wall, the D4 RIN price really is a function of the D6 RIN price, but also in probably much more feedstock prices. And so given the fact that we expect some short-term weakness in feedstock prices, and then we expect a kind of a relatively wide trading range, that's where you get sort of the steady outlook for D4 RIN prices, or the generally steady outlook for D4 RIN prices. LCFS credit prices, we haven't changed our thinking on this, although in the short term, LCFS credit prices seem to have kind of stabilized a little bit last week around the $150 level. We'll see if they can hold that level. But again, with the expansion in renewable diesel capacity, I think it's going to be hard for those prices to hang on to that level for an extended period of time. And we would expect them to start to move lower again. All right, so I've used up most of my 30 minutes, and we will try and get on to questions. Next week, I'm going to be on vacation. I think Ryan is going to, or at least I'm going to ask Ryan to fill in for me. If not, you're going to see me from the side of the road someplace, so you won't see this nice background. Next week, you'll see me wherever I am traveling to, or driving down to the Keys. And so I may just pull off to the side of the road and try and find a nice beach background. All right, with that, let's get on to questions. All right, I know we are here to talk about veg oils mostly, but what is going on with such low LCFS credit prices, $158 per credit, exclamation point. Any further updates on why that downward trend persists so strongly? Is it still the faster than expected ramping up of RD plant capacity? Yeah, the short answer is yes. In doing our longer term outlook report, took a deeper dive into the LCFS section than I've ever taken before. And if you look at the growth in renewable diesel credits over the past year even, it's just really stark in the percentage of the credits that are generated from renewable diesel now versus a year ago or before. That probably is only going to get worse as renewable diesel capacity expands. Now, of course, built into the LCFS program is this continual reduction in the number of credits that are generated per gallon of fuel, and there's an increase in the number of deficits that are generated per gallon of conventional fuel. So there's probably going to be a spot where that catches up with renewable diesel production, but I think renewable diesel production is going to have to stabilize before that happens. And certainly until we know exactly what renewable diesel production is going to look like in 2022 and how much of that is then going to go to the California market, I think that that traders are probably going to continue to put pressure on prices. And in addition to the increase in renewable diesel production, the other thing that sort of stood out in the LCFS credit price data is that there's a fairly significant number of non non-cash players, I guess, speculators for lack of a better term, in the LCFS credit market. And just like with soybean oil, they probably overshoot to the upside and overshoot to the downside. And so unfortunately for the renewable diesel producers and biodiesel producers that want to ship into the California market, I think it's going to be tough to find a bottom in LCFS credit prices. I don't know where that bottom is, and I've got to say, it wouldn't surprise me if that bottom is 150. It wouldn't surprise me if that bottom is 100. I don't have a great sense because there's so much uncertainty about the capacity coming online. I don't have a great sense of exactly where that bottom is going to be. Will Biden's RVO announcement higher than expected for 2021 and 22 correct the downward trend of RIN veg oil markets? So I think you saw a bit of that after the announcement, where D6 kind of caught a bid. I think the SRE, the lack of SRE, the lack of granting of SREs is going to leave those companies that sort of very publicly announced that they were short RINs needing to buy RINs. And so that is going to provide some support. The estimate is sort of more than $2 billion in carried over deficits. And so they're going to need to make that up. Whether the EPA will give them some time to do it, they can naturally carry over some deficits from year to year. Whether the EPA looks at this and says, okay, well, you have these huge deficits, you can't make it up in a year, it'll be disruptive to the market, so we'll give you some time to make those up. I don't know, but if I were those companies, the way that I would be looking at this situation is I could have been forced to purchase those RINs when they were at significantly higher prices, and now I can purchase them at much lower prices, albeit still higher than they have been in a long time. And so from that perspective, I've kind of already won. It was already kind of a good trade to take that approach. I don't know that that means that they're just going to then plunge in and buy everything that they can, or everything that they need to, because again, if I were them and I were looking at all of this capacity that was coming online, I might think that, well, there might be some more downside for RIN prices. I don't necessarily think that that's true. But again, if I'm just looking at what the soybean oil market is doing, I would say that maybe potentially there's some more downside for RINs, and so maybe they buy them back a little bit more slowly. For veg oils, again, I think we are just kind of in this liquidation phase, and the market will find a bottom, and then I think it will need to start to work its way back higher. Ultimately, I think that feedstock prices are going to have to go to a level that's going to force those biodiesel producers out. We have biodiesel production going in a steady trend down. The year over year decline from last year to this year is a bit bigger than the declines going forward, but we have it going down steadily until we get down to basically just the large producers and the integrated producers, and that's kind of it. And so it's going to be tough to force them out of business if they're making money, because what else are they going to do? And they're certainly not going to shut the plants down until they have to. So I think that you ultimately will get a rebound in vegetable oil prices. But again, we're sort of in this liquidation. Will CARB move the goalposts as LCFS prices plummet? I have yet to see CARB do a lot of things the same way that the EPA does, I guess is how I'll say that. It seems to me that they've had a plan, and they've kind of stuck with it, despite the fact that some of their assumptions about where we would be right now in terms of electrical vehicle adoption and biodiesel production haven't been super accurate. And so I think that given the fact that they have the built-in reduction in credit generation and the increase in deficit generation, I think the fact that that's built into the program kind of provides a self-stabilizing mechanism for LCFS credit prices. Now, they're also getting a lot of renewable fuel because of those credit prices, and even at these credit prices. I think the interesting thing will happen, or I think what will be interesting in the future, is that as LCFS credit prices fall, then as a renewable diesel producer, you have the opportunity to ship to the Oregon market or the Washington market or to Norway, and potentially soon to the New York market. And so in addition to what CARB has built into the program, I think those outside markets, although they're vastly smaller than the California market, will also provide some competition for those fuel supplies, and will start to stabilize LCFS credit prices. I do think that they'll stabilize and start to come back up, but again, I just don't know. I don't have a great sense at what level they're going to stay, where the bottom is. All right. If the market was expecting the changes in the mandate, why does it seem like so many were caught off sides besides what's happening in the futures? I think there's expecting, and then I think there's when the news comes in, right? There is always some of buy the story, sell the fact kind of thing. And now that we know, you've taken some of the uncertainty out of the market. And so while a lot of people expected, and a lot of people wrote about where they expected the mandates to be, a lot of traders are going to take a position that is, okay, well, what if they don't cut 20 in 21? And if you looked at the law, I think you could make some strong arguments for that trade. And so I think that the combination of that, the combination of expected expansion in renewable diesel capacity, and just the massive size that we've seen in the short position, or in the long position for soybean oil futures for such a long time, just kind of takes some time to unwind. And then beyond that, once you realize that, hey, maybe prices aren't going back to 70 cents and there's some momentum to the downside, then you get people piling on to the downside. And that's why we probably will go below where the fundamentals will justify on the downside and then start to bounce back up. I think that ultimately the real demand from renewable diesel producers is what's going to finally set a firm and hard bottom for soybean oil prices. But until we get that, and again, we don't expect that to come. I mean, if they're buying 3 months ahead, that would come at the end of the year. If they're starting on March 1st, we expect capacity to start to come online in the second quarter. And so over the next couple of months, you have a situation where you don't really have all of that physical demand coming at the market. And then also remember, we're also in the middle of the Brazilian growing season, and things are going well down there. That's not weighing as much on the entire soybean complex, in part because there were a lot of people that were long oil share, and they're unwinding those positions. So they were long soybean oil and short soybean meal. And since soybean meal represents a bigger portion of the overall value of the crush, as they liquidate those positions, it lifts soybean meal prices and then supports soybean prices as well. And I think that mechanism is probably hiding some of the fundamental weakness in soybeans. I mean, there are some concerns about dryness in Argentina, but for Brazil, we're expecting a huge crop, a record crop that's significantly bigger than last year's crop. So I think beyond what's going on in the biofuels marketplace, I think there are other factors that are probably also weighing on soybean oil prices. All right, I think. Oh wait, one last question. How many years out does the Jacobson forecast biodiesel prices? Any projection regarding a renewal of the BTC beyond 2022? So we project fuel prices out for a couple of years. And to be honest and frank, we are not the world's best biodiesel price projectors. I would say there's a lot of the energy complexes influence in that price, and we honestly don't have a model for all of that that's as detailed as our models are for the feedstock markets. At some point we will, but today we don't. And so we don't really project biodiesel prices out that far. In terms of the blender's tax credit, the proposals that I've heard have mostly been some variation on a renewal with either a declining value or that eventually sunsets, or a renewal with a lower value that then maybe even declines a little bit, but then reaches some steady point and then goes on until it sunsets again and then potentially renews again at that lower level. What I haven't heard a lot of is people believing strongly that the EPA will renew the blender's tax credit at $1. There probably will be significant pressure on the EPA to do that as we get into 2022, especially if biodiesel producers are under pressure from higher feedstock prices and effectively can't make money with that. I don't know that the administration will support them. I think this administration is obviously focused on the environment, and so that sounds a little bit counterintuitive, but I think that what they view as the long-term solution to this problem is electrical vehicles, or this issue is electrical vehicles. And so I think they would like to as much as possible kind of drive people to increase the rate of adoption for electrical vehicles. And then where I think they would like to see significant growth in fuel production is in aviation fuel. That's a big market. And I think ultimately there may be sort of an LCFS type program for aviation fuel that's nationwide, and that you sort of break sustainable aviation fuel out of the RFS kind of, and it has sort of its own program. And so if you look at it from that direction, then I think the idea that the blender's tax credit could expire, or at least be reduced to a lower level, 50 cents or something. I think there's a much higher probability that that happens than it gets renewed at its current level. Now, the most likely outcome is what has typically happened in the blender's tax credit, where nothing happens, and then they go for a year or 2 years or 3 years, and then they renew it retroactively. If I had to go to Las Vegas and place a bet on one of the outcomes, the nothing outcome would be where I would put my chips. All right, I think that is it. Thank you, everybody. I will either see you next week, or I won't see you until the beginning of the year. After next week, the following week, which is the week between Christmas and New Year's, we won't have a webinar, and we won't write a report that week. So if I don't see you next week, I hope everybody has a safe and happy holidays, and I will see you next year. Thanks for attending.